Welcome back to the Australian Fund Monitors Meet the Manager series. DS Capital is a Melbourne-based investment manager, and their fund, the DS Capital Growth Fund, was started in early 2013 and aims to deliver an average return of at least 10% per annum through the economic cycle, with a focus on preserving capital. The fund has returned 14.9% per annum since inception, outperforming the ASX200 Accumulation Index by 7.35% per annum. The fund has also been very successful in preserving capital by avoiding protracted drawdowns and has a down capture ratio of just 45%. I'm joined today by Rodney Brott, CEO, Executive Director of DS Capital, and the co-portfolio manager of the DS Capital Growth Fund. Rodney, thanks for joining me.
Thanks for having me.
Rodney, 2020 has been one for the record books, and the fund has performed very strongly so far. How has DS Capital managed volatility for the last 10 months?
The volatility's certainly been quite stomach churning. Our portfolio is reasonably well diversified. We're not pure growth. We're not pure value. We have a universe of opportunities that we feel we know quite well. And when a macro event comes along that sends everyone for a six, it's up to us to take some of those opportunities and be able to purchase some investments that we've been looking at for quite some time from emotional sellers. So overall, it's an interesting opportunity for us, but you really have to hold your nerve and make sure that you stick to your knitting, go through your investment process, do your homework, and have a reasonable expectation of how long it's going to take to see returns. And in our case, we make investments expecting returns over the next 2, 3, 4, 5 years, rather than buy something today and see it higher tomorrow.
In a recent article on fundmonitors.com, we highlighted that one of the most consistent traits of managers with long-term outperformance was the ability to avoid big drawdowns. This is something that DS Capital focuses on. What do you do within your process to manage this?
Our fund has been operating for almost 8 years ago, and we've been fortunate enough to avoid those big drawdowns. The way we look at investing is it's not really a month-to-month proposition. It's a long-term game that never really finishes. We look more at our average returns over the longer term rather than the shorter term returns, because fundamentals are what carries a business's share price over the longer term, whereas in the shorter term, share prices are mostly dominated by psychology and emotion, etc. Now, our portfolio is reasonably well diversified. We're not pure value. We're not pure growth. We also carry a certain amount of cash. For the staff at DS Capital, this is their primary exposure, or their only exposure to listed equities markets. And therefore we eat our own cooking. So sometimes we might have 15% cash, sometimes we might have 40% cash. We also have a preference for businesses that have a long track record of delivering consistent and growing cash flows and annuity style income. And that generally puts us in a good position when a macro event comes and businesses that may have been on high PEs and in some case multiples of sales start to face a turbulent environment, and they don't really have a valuation metric to fall back on. And in our case, having businesses that have consistent track records and delivery of cash flows and profits is very helpful in more turbulent times.
The US election is all but done and the market has reacted, but closer to home, we've seen a move to record low interest rates. What effects do you think this will have on the outlook for 2021?
Look, interest rates are certainly at historically low levels. And the very strong consensus is that interest rates will remain lower for longer. In those circumstances, there's no doubt that asset classes such as equities are favoured as investors look to take money out of the bank and invest it in something that will deliver a better return. Also, the fact that money's cheap allows companies to borrow more, expand their businesses, etc. Now, that's all very good, but the low interest rates that provide a helpful input to valuing businesses through using a interest rate in determining the present value of cash flows means that those businesses are worth more today at lower interest rates than they were previously at higher interest rates. Now, the risk of that is that not all cash flows are the same. There are annuity style cash flows that are more dependable and reliable, and then there are cash flows that are dependent on one-off events such as government stimulus, et cetera, or cyclical things. It's our role to make sure that we're putting on an appropriate risk premium to those cash flows. So when we're valuing our businesses, we have a strong view that they're more dependable and reliable than businesses that may be reliant on shorter term things. So over the long term, if we've bought a business on a multiple that then derates because of changes in interest rates, and that's certainly a risk to the markets, particularly where interest rates are as low as they are, then at least we're owning a business with a growing stream of dependable cash flows that in the future, in theory, should be worth more than it is today. And that will give us some insulation from a change in PE multiples due to a change in interest rates.
Rodney, I think you've just raised a very salient point for a lot of investors, particularly around what they do with money that's not earning a great deal in the bank. Thank you so much for your time today, and good luck in 2021.
Pleasure. Thanks for having me.